Picture this. You're riding high. Your investments are doing well. In fact, better than you imagined. But then markets start falling. You've lost 3%, 5%, 8% of your gains, and things keep going south. It's scary, very emotional, and you, as an investor, start fearing the worst. But while a market correction can be damaging in the short term, they can actually be positive. In this episode of How to Invest by Julius Baer, we look at how you can manage a market correction. First of all, what is a market correction? Well, technically, it's when a bull market drops around 5 to 10% in value. Ouch. This can hurt your portfolio and it doesn't feel nice. But a bull market, one that's on the up, doesn't go up constantly. That would be too easy. Remember a few episodes back when we went for a walk in the park with Man's Best Friend? We were trying to go from A to B, but the dog runs all over the place. At the end, we both end up on the other side of the park, but the dog has been running up and down, left and right, backwards and forwards. It's what markets do. Sometimes they go off course a little more than expected. And that can happen for all sorts of reasons. Big global events, market sentiment changes, or even if earnings are just disappointing. Investors start to realise that prices were too high before, and so if there is no demand, prices come down. But here's the important thing. Just because prices go down, it doesn't mean that all companies are suddenly bad or that you should panic. It's just a normal part of how the market works, like a little bump on the road. Over time, things usually go back to normal and the market starts to go up again. So it's important to stay calm and think long term when you hear about a market correction. In fact, a correction can even be a healthy development. It allows markets to adjust to stretched positioning, providing you with buying opportunities. So what should you do as an investor? Well, corrections can last anywhere from days to months or even longer. And while they are far from uncommon, market corrections shouldn't worry long-term investors. Stick to your plan. Remember that plan that you made before you even started investing. Make sure that it aligns with your financial goals, risk tolerance, and time horizon. Keep to it, even when the market gets turbulent. For more on that, check out our previous episode on how to build a balanced portfolio. Remember that investing is a long-term game. Market corrections are temporary setbacks in the broader trajectory of the market's growth over time. Resist the urge to make impulsive decisions based on short-term fluctuations. Emotional reactions often lead to selling low and buying high, which is exactly the opposite of what you want to do as an investor, and also happens to be a focus of a previous episode. There we cover all the basics of good investments. We even have details on spreading your investments across different asset classes to reduce risk, which is another way you can protect yourself against the difficulties of a correction. Like and subscribe to our YouTube channel for the latest insights in how to invest. And if you have investment questions you would like us to answer, just comment below. We'll see you again soon.